If you have a long-term tenant in there, if you can get a 10 or 15 or 20-year lease with a good, a strong credit tenant, that's about as close to anything in real estate that you're going to get to risk-free. And so 6% risk-free in real estate, I think isn't too terrible.
Welcome to the Bar Down Investing Show. Here are your hosts, Kyle Wilson and Jay Scott.
Well, hey there, and welcome to another episode of the Bar Down Investing Show. I am your host, Kyle, more affectionately known as Ashley Wilson's husband. Once again here with my bestest buddy, Mr. Jay Scott. How's it going, Jay?
I am doing well. I'm excited. Next episode, this one we're doing it from 1,000 miles away, but next week we're actually going to be in the same city, same location. We can actually record a live podcast together, at least an in-person podcast, if not live.
You got enough room for me in that little office of yours there?
Oh, we're going to find some nice swanky place to set up and film and record. I don't know where, but it'll be good.
Let's do it outdoors. I'm up in the Northeast right now. It's pretty cold.
Yeah, it's cold here. I don't even think it's 80 here today.
I'd definitely take that. Hey, well, you got any wins that you could share with me this week? Let's check in.
I don't have any wins. I have a loss. Do you want to hear about my loss?
Ooh, I love actually hearing about losses.
Yeah, so I have an angel investment loss. So I invest in a startup tech company. I invest in some of those. And I got that email that we all hate to get when you're invested in startup companies. But I got the email a couple days ago that the company is shutting down. Basically, they ran out of money, couldn't raise more money. I think it's indicative of what's going on in the market these days. It's really tough to raise money, which is funny. I mean, this is a topic for a whole separate conversation. I won't go down this path, but right now, venture capital and angel investors have like a ridiculous amount of dry powder, something like $300 billion in cash sitting on the side to invest. But they're being very stingy with where they're investing it. So a lot of startup companies that are looking to keep going and need to raise some more money are having trouble raising. And this company, unfortunately, couldn't raise any more money. They ran out of money and they had to give up. So lost my investment there. So there's my loss of the week. Company was named Renault. Good company, good founders. Unfortunately, they just had some bad timing with their running out of money.
Yeah, the thing about angel investing is that does happen from time to time, but hopefully that's only 1 out of 10, 1 out of 5, and the other ones can just pick up the slack for you. So you got any better news for us for scorecard?
Yeah, so the scorecard. So I do have a win this week. According to YouTube, our YouTube channel has now 250 hours of total watch time. So basically, our YouTube channel basically consists of this podcast, and viewers have now downloaded and watched 250 hours of this podcast. So hopefully people aren't getting sick of us yet, but that's a huge milestone, I think.
That's a long time to be staring at our ugly mugs. That's pretty impressive. Great.
So how about rock updates?
Yeah, that's what I was getting to next. Nothing real controversial this week with The Rock. Nothing new coming out. So I'm going back to his cheat day meals. It's one of the best things about following The Rock on Instagram is he posts his cheat day meal, and I thought it was timely because Jay and I at some point here we're gonna get a diet going, right? So The Rock's Sunday cheat day meal was coconut pancakes. And then he literally started the video by just smothering it in peanut butter and syrup, and it looked delicious.
Awesome. That's it.
You okay over there? You writing emails in the middle of the podcast? I could hear you. I could hear you typing away there.
I'm doing a search for The Rock. I was trying to find something more interesting there because, sorry, but that's a really uninteresting Rock update. So I was literally doing a search for The Rock.
Can you imagine if someone tried to update your life every single week? Like, it's not, no one's that interesting.
Fair enough.
All right, fine. If you're not interested, let's move on to the headlines. Once again, pretty boring week. I guess this we got to work hard here to get our ratings up. But headlines though, this is a great headline. I thought though, the apartment list national rent report came out again. They do it monthly. And finally, after 5 straight month-over-month declines, we saw an uptick. It was a small uptick, 0.3%, on their national rent index, but we saw an uptick. And so that's similar in magnitude to a typical February price change that we saw pre-pandemic. So those people who were, hit the panic button that the rents are going down. This is a bit more of an indication that we're kind of just back to normal instead of these crazy rent increases.
Yeah, I'm not convinced that this is indicative of where things are headed. I have no idea where things are headed. Maybe it'll continue to keep going up. Maybe we'll have another month or two of down. It's unclear where things are headed, but this is definitely a good indication that things aren't off the rails and maybe back to normal. And I mean, part of this is probably likely due to the fact that we're still seeing decent wage growth out there. So employment is all over the place, as we've talked about in the past, but wage growth is still relatively strong. And as long as you see wage growth, you're probably going to see rent growth. And so this is just indicative of the fact that at least parts of the economy are still pretty strong.
Yeah, it's obviously market to market, where you still saw some markets with decreases, but the overall trend was a small increase. And once again, market to market, you got to keep a little eye on the fact that there's a huge supply coming on in some markets for a new supply in multifamily. So those might feel a little bit of a squeeze with those, but maybe that's a discussion for another day. We also have investors buying roughly half as many homes as they were a year ago. Any thoughts on that one?
Well, if anybody that's listening to this podcast is surprised by that, you need to listen to this podcast more often. So it shouldn't surprise anybody that investors are finding it more difficult to find good deals these days. And especially in the commercial world, where sellers aren't really coming off their price, buyers aren't willing to come up. We're just seeing a lot less transaction volume in general in the investing world. So it shouldn't surprise anybody that investor activity is down tremendously. 50% over the last year. That's a good bit. But think about where we were a year ago. I mean, beginning of 2022, interest rates were still at pretty much 0%. Values were still going up. Nobody was really concerned about the economy. We saw some inflation, but that was about it. So a lot's changed in the last year, and yeah, so it's not surprising to me that we've seen a good downtick in volume.
Yeah, it was interesting that actually the percentage of all homes bought by investors actually ticked down a little bit too. It was at 17.8% of all homes versus the 19.4 back in Q4. So you would think, yes, it makes sense that the overall amount of homes being bought went down based on interest rates and market conditions and whatnot. But investors making up less than the actual overall percentage is interesting. But if you listen to Grant Cardone, he had an interview last week, and he says there's not going to be a home sale crash, because the moment we start to come down, then investors will step in and, quote, save the day.
Yeah, I've seen that quote a few places. I know it's pissed off a bunch of people who are basically thinking, okay, investors caused this bubble in real estate and caused values to go through the roof. And I'm not saying it's not somewhat true, but now they're starting to say that, yeah, if that's true, if prices start to decline and investors kind of swoop in, we're basically going to continue to see this crazy run up in prices, which, I'll be honest, as an investor, I love it. But as a normal person, I realize it's not necessarily sustainable. It's not necessarily good for the average American out there who wants to buy a house and live that American dream. And so I think at some point we're going to have to see a stabilization in prices, maybe even a drop in prices. I don't think we can avoid it. So while what Grant is saying isn't necessarily wrong, I'm not convinced that that's necessarily going to be a good thing.
No, it's all a balancing act, right? It's the cure for high prices is high prices. The whole, all the same thing. As prices go down, more investors, it's going to make more sense for the numbers to work for them. But then the more investors buy, it's going to drive the prices back up. And then that's going to, start this whole cycle again. And then rents, where are rents going to go with the new supply in multifamily? And they kind of push on each other. So it's impossible to, he might be right. He might be wrong. It's impossible to really tell at this point, especially with we still have that J Money Powell making decisions coming up again. We got another interest rate hike coming up in a month, so we don't know what's going to happen there. So it's a tough time to be predicting things. But one thing that has been doing well, I thought was super interesting, is triple net car wash sales remained robust in 2022. You saw almost every single commercial asset class fall off a cliff, the amount of transactions, except triple net car wash.
And I love this stat because this is just a good reminder for anybody out there that kind of lumps all real estate together. They say, yeah, real estate's doing well, or real estate's doing horribly, or maybe they break up residential versus commercial. They say residential struggling and commercial is doing well, whatever. It makes you realize that you can niche down pretty far in real estate. And no matter what's going on in the economy, there's probably going to be some opportunity somewhere. And this is just a good example of that. And so triple net car washes, who even knew that was a thing? So I assume that means that there are real estate investors out there who are going and buying land and leasing out that land for car wash operators to basically build or operate a car wash, triple net, meaning that the operator, the person leasing the land, is paying the taxes, the insurance, the maintenance, basically everything. And so it's just a passive land play. And it's just interesting. So for anybody out there that's thinking like they just want to sit on the sidelines because there's no opportunity anywhere in real estate right now, clearly that's not the case. You just need to dig
get
up
into
that
triple net car wash. Yeah, I thought it was super interesting. There's if you're looking at let's just say multifamily, commercial multifamily, which is considered one of the safest asset classes. We're getting into cap rates into the fives here in some markets for major markets, not even tertiary, like with just major markets. We're seeing cap rates start with a 5 in some places. The average cap rate of these triple net car wash leases was a 5.8. So they're not that far off. So people are saying that these triple net car washes, they are, cap rate's a good indication of risk. They're getting close to the same risk level of large multifamily apartments. And not only that, 5.8, that's less than the loan rate. So that means that people are willing to take a little bit of arbitrage loss for the first few years just to get into the car wash space. So I thought it was super, super interesting headline.
It's true. I mean, they're taking a loss, but I liken triple net real estate to pretty close to risk free. If you have a long-term tenant in there, if you can get a 10 or 15 or 20-year lease with a good, strong credit tenant, that's about as close to anything in real estate that you're going to get to risk free. And so 6% risk free in real estate, I think, isn't too terrible. I mean, yeah, it's lower than interest rates out there. You're going to be arbitraging interest rates and potentially losing a little bit of money there. But if you buy in strong locations that are going to appreciate over the years and you have a strong tenant where you don't have a lot of risk, I mean, would you rather be putting your money into bonds or would you rather be putting your money into this? I mean, keep in mind, you don't have to get a loan. You can pay cash and get 6%.
That's true. But I don't know. I guess my one of the best things about real estate to me is the fact that you can get that loan and you can get that extra pop. And I'm willing to do a little bit of negative arbitrage because everything that we buy has that value add component. You can artificially raise the NOI and you can increase the value of that property, so you could flip that back the other way where your actual cap rate is higher than the loan rate at the end. Versus triple net, you're kind of just locked right in there. But yeah, it's there are people who are okay with those single digit returns, and that's a pretty safe play.
Yeah, and this is a good place to remind everybody, and I do this often, but there's money to be made in real estate besides just that cash flow. So even if you're not making much in cash flow, or you're negative arbitrage, negative leverage, because interest rates are higher than cap rates, well, you still, if you have a fixed rate amortized loan, you're still paying down that loan every month. So you're building equity on the loan. You're going to see some appreciation. I mean, even if it's just appreciation at the rate of inflation over the years, you're going to see some appreciation. And you're also going to get some tax benefits. So when you add all that up, that 6% return could actually be 8, 9, 10% return.
That's very true, and the operator probably gives you free car washes too if you own that land. So there's all kinds of bonuses. I'm going to add one more headline that I didn't see as a headline, but I feel like we're not going to see it as a normal headline, but it's definitely a trend we're seeing. In that we've definitely seen over the last few months sponsors halting distributions on syndications and projects, but now we're starting to see actual capital calls. And you're not really going to see that in the news, but because it's kind of a dirty little secret. But I didn't know if you wanted to discuss capital calls on this podcast.
Interesting. I didn't think you were going to bring this topic up, but I'm certainly willing to go there. I mean, I've started hearing a lot. I'm a member of a bunch of limited partner internet forums, basically places where passive investors get together to invest, because in addition to running syndications, I know you and I are both investors in other people's deals. So I get the insight into other people's syndications and deals and how they're doing, both through my investments and through other people in the community. And yeah, what we've been hearing a lot about over the last few weeks and even months is that there are some deals that are, I don't know if I want to use the term struggling, but struggling. Distributions are slowing down. Some groups have stopped doing distributions altogether. And in some worst cases, we've seen some groups that are doing capital calls, which is basically a situation where the group says to their investors, hey, we've run out of money. We need more money for something, whatever it is. And they ask their investors to put in more money into the deal that they weren't originally planning to put in.
Yeah, so you want to move this to the issues list, and then we'll discuss it a little bit further?
Yeah, I probably already started with my discussion. I probably already started looking at an issue. So yeah, let's talk about this in more detail.
Yeah, you touched on what a capital call is a little bit there, but to go in more depth. So a capital, every time someone signs up for a private placement, there's a provision in the PPM legal documents about a capital call, and it's basically that, in any private equity, a syndication group has the legal right to demand more money from the LPs. Because of the way the real estate market has worked in the last decade, to be honest, there hasn't been many capital calls, so people don't really talk about it. And these PPMs are sometimes 100 pages. And I'm sure there's many people who read all the way through it, but there's other people who kind of just breeze through it. And we make sure to mention there's always the chance of a capital call, but it hasn't really happened in a while, so people don't really think about it. And so for whatever reason, if the investment needs more money, basically the sponsor can come and say, hey, we need more money and it needs to come from you.
Yeah. And so we've started to see that. A couple of the reasons that operators may need more money. Number one, let's say they need to do a refinance. Let's say their loan term is coming due and they need to do a refinance. Maybe they have a $5 million loan on the property, and when they go to refinance, because the way the economy is right now, the bank says we're only willing to do a refinance at $4 million. So the operator has two choices. They can not do the refinance and potentially lose the property because the bank's going to make them refinance, or they go to their investors and say, we need to come up with $1 million difference between that $5 million loan we had and the $4 million refinance we're going to get. So that's number one. Number two, it could simply be that with interest rates going higher, there are a lot of investors out there, a lot of operators out there who have less cash flow today than they had 6 months ago or 12 months ago, and a deal that was barely cash flow positive or just a little bit cash flow positive 6 months ago now may be cash flow negative. And these groups need to still do repairs, and they still need to do capital items. They still need to pay their taxes and insurance and pay their property manager. And so if they're running at a deficit every month, they may ask their investors to put in money to kind of cover that negative until interest rates come down or until incomes go up and they can start making monthly cash flow again. And then the third situation that we're seeing is we've talked a little bit about rate caps, that insurance policy that a lot of operators are required to get when they have floating rate loans to ensure that loan interest rates don't go too high. These policies, these insurance policies are getting tremendously expensive. And so for operators who are coming up on the expiration of an old insurance policy, a rate cap policy, the new policies are much, much more expensive, hundreds of thousands or millions of dollars more expensive. And operators may need to go to their investors and say, we need more money to buy these new insurance policies, and do a capital call to collect money for that. So multiple situations we're seeing in the finance world these days that are requiring many investors, or at least some investors, to go to their passive people and say, hey, I need more money.
Yeah, and capital calls aren't always doomsday. Like those are typically people think of capital calls or hey, it's, there's lower performance or something changed in the market, or our business plan changed, or things like that. But there are situations where capital calls just kind of happen where if someone has a renovation budget and the renovation budget just didn't quite cut it, they needed a little bit more money, but everything's still on track. We had to do a little bit more to finish our full renovation. You see that happen. Or in the case one of our properties too, there was the potential opportunity for purchasing additional units to add on to the apartments that we currently had, which obviously would add on to the value. We would have purchased those units at a lower value than what we resold them. So the capital that would have gone in would have come back out at a higher rate. We didn't end up purchasing those units, but it was something that if we had the opportunity to buy those units, we probably would have said, hey, let's put some more money into this so that we could buy those units and make it a better asset as a whole. So it's not always doomsday, but right now when you're seeing capital calls, it's usually because, as you said, interest rates go up, or which is pushing up rate caps, or just performance is struggling and they need to put some money in. What is concerning me is the capital calls that I've seen happen are the more experienced investors. So you could read that one of two ways, that, is this the people who we thought are experienced, are they not as experienced, or are they just getting in front of this because they have the experience and they know, hey, I see the writing on the wall, things are going to go south. Let's get in front of this. Let's do a capital call. And so we can weather that storm, versus the inexperienced operators. They're the ones who are kind of, we don't want to seem that things are going poorly. We don't want to do that capital call.
Yeah, 100%. And so it'll be interesting to see, like you mentioned, there are a couple really big names in the industry who've come out and said we're doing capital calls, but they said exactly what you said, which is we're not doing it necessarily because things are really bad. We're doing it because we want to get ahead of the issues. And number two, we want to be the first persons with our hands out. So if an investor's invested in 10 deals and they're going to get 10 capital calls, you probably want to be the operator doing the first capital call, because you're more likely to get money from that investor than if you're the 10th in line. So it may not be a huge issue, but I was reading an article last week, and I'll see if I can dig it up, and if so, we'll link it in the show notes. But there was an article about a group out of Texas that started investing a few years ago. In 2022, I think it was, maybe 2021 and 2022, they brought in about $1.6 billion worth of commercial real estate that they syndicated. And basically, 2021 and 2022 probably weren't the best years to be bringing in billions of dollars in real estate, especially when it appears that they got a lot of floating rate loans. And so now they have an entire portfolio, over $1 billion, that's at risk. And so there are certainly going to be operators out there that scaled too quickly, or scaled at the wrong time, or scaled in the wrong ways, that are going to be facing issues. And so it will be interesting to see if the operators that are doing capital calls, if it's one or two properties out of their portfolio that are struggling because they're just in a bad situation, or if it's more indicative of some chronic issue where they scaled too quickly, they bought using the wrong criteria. Their underwriting wasn't strong. It'll be curious to see if we see whole portfolios start to go under for some operators that just didn't do things the right way.
Yeah, it's interesting that you bring it up because it was obvious that some properties were going to have to pause distributions just with the increase in interest rates and the rate caps and stuff like that. That was pretty obvious. But then we even started to see whole funds pause distributions, which you could see funds, like not every single property in a fund is going to be typically on a floating rate loan. So it's going to be affected by that. Our property is only one of them's a floating rate loan. Our other ones are fixed rates. So obviously the performance on between those are going to be completely different. But if they were in a fund, you would think it would kind of smooth it over a little bit. Now we're even seeing funds that are pausing distributions. I haven't seen any do capital calls for an entire fund yet, but that could be on the horizon. Little plug though, which is interesting because we had a discussion before about capital stacks and pref equity being on the capital stack. We're not going to name who the operator is, but Jay and I are actually invested in the same operator, and Jay is in the common equity, and we are in the pref equity stack. And the common equity got their distributions paused, but our pref equity still churning out distributions. So that's an interesting plug going forward on that one.
Yeah, it's a good reminder that there are lots of different ways to invest. There's lots of different ways to structure your deals, whether you're on the operator side or the passive investor side. And you should always know what you're getting into, what the risks are. And yeah, you went a lower risk way than I did, and now I'm not seeing distributions for at least 2 months, and you're still getting your money. Yeah.
So when we talk about capital calls, though, we touched on people don't typically read through the whole provision of the capital calls because we haven't really had many capital calls in the last decade. But what if you are lower on that list and you reach out to your LP investors and ask for a capital call and they say, hey, I don't got any money left. I already gave A, B, and C money to their capital calls. I can't put into this deal. Then what happens?
So and this is actually interesting because again, every deal is going to be structured differently, and we typically see two big classes of deals when it comes to capital calls. And always make sure if you're going to invest in a passive deal in a syndication or a fund that you read the docs really closely. And this is one of the things you want to read the docs for. But kind of the two big classes of capital calls that we see in these types of deals are mandatory and optional capital calls. Mandatory meaning if the operator needs money and does a capital call, the investors in the deal are required to put money in. If they don't put money in, they run the risk of getting diluted, potentially getting kicked out of the deal. They don't have a lot of options. And the penalties for not contributing money in the capital call, not putting in more money when asked, are pretty severe. On the other side, we have these optional capital calls, which basically means if the operator asks for money, if they need to do a capital call, the investors have the option of saying, nope, I don't want to put money in, or I don't have the money to put in. They don't have to give a reason. They just say, no, I'm not gonna participate. And then the operator has the option of doing one of a couple things. They can go out and they can find other investors to cover that shortfall, in which case the people that didn't put money in might get diluted. The operators can decide to give a loan to the company or go out and get a third-party loan to the syndication or the fund to kind of cover things. Or they can go to other investors and say, hey, do you want to cover the shortfall of your fellow investors who aren't putting money in? And again, they may get extra equity and the other investors may lose some equity. But basically, you want to read your documents very closely to see if there's a capital call. Is it going to be mandatory? Is it going to be optional? What happens if you choose not to put money in? Do you get diluted? Do you get kicked out? Because for many years, for the last decade, there haven't been a lot of capital calls. And so investors aren't thinking about this. They're not reading the documentation. They're not, as somebody who raises a bunch of money for our deals, it's very few and far between that I get investors who want to dig in on the capital call language in the documents. And so I have a feeling moving forward, investors are going to be a lot more aware of that language, and they're going to ask a lot more questions. And so make sure if you're one of those passive investors that you're really thinking through what you're willing to invest in when it comes to capital calls. If you're an operator, really think about how you want to structure your capital calls, because investors are going to start asking questions about them moving forward and be making decisions about whether they're going to invest in deals based on how you're structuring capital calls in your deals.
Yeah, the whole interesting thing about this to me is this going to change investor expectations? Because the thing is, we had such a good run there for such a long time. Investors were getting sometimes over 20% returns, to the point where when we were raising money for a very low risk pref fund, people were sometimes saying, "Hey, you know, I'd rather take the risk. I'd rather go for this the full equity option and you know, and chance it out." Now that we're seeing some capital calls pause distributions, do you think that's going to change expectations of investors?
Yeah, so I've actually already over the last few weeks, and I don't know exactly why this is, but we're already starting to see more people that are interested in our lower risk fund. And I'm not here to push the fund. I'm not doing that, but I'm just pointing out that this may be an indication that people are starting to recognize that there's more risk than was being perceived even just a few weeks or a few months ago. People are starting to realize that multifamily and commercial aren't immune to the economy. And so, yeah, I have a feeling that over the next couple months, as more seasoned investors start to see their deals at more risk, they're going to look for lower risk things to invest in. And I think new investors are going to start hearing about some of the things going on, and they're going to be more hesitant to jump into these traditional investments, and they're going to be looking for lower risk things as well. So I think we are going to see some changes. I think people are going to be more skeptical about deals. They're going to be more due diligence around these deals, and the good operators are going to stand out, and the bad operators are going to struggle, which is the way it should be.
Yeah, exactly, and maybe bring some people back down to earth a little bit here. It was great to we were projecting mid-teens on investments and getting in the 20s, and so when you told somebody, hey, this investment's going to perform in the mid-teens, they're thinking in the back of their head, oh, they're just saying that's going to be somewhere in the 20s, and hopefully that comes back down to reality a little bit, and they can start doing a better cost, risk, profit analysis in their head and make better investment decisions. So great. Hopefully we don't see a lot more capital calls coming, but if we do, then hopefully it will lead to a more healthy market in the long run.
Yep. And knock on wood. All of our investments are doing tremendously well. So for any of our investors out there who are listening, don't take this discussion as us like trying to prepare you for anything. All of our deals are actually doing really well, and so we made some good decisions along the way. We've gotten some really good fixed rate loans, and we bought some good properties, and I like to think that we're pretty good operators. So knock on wood.
I did physically knock on wood when you said that. And
I'm not superstitious, but hey, why not?
We would still love for J Money Pal to put a pause on for us. That would still help everybody out.
Exactly.
Great. I don't know if we have anything to do for the to-dos list here. Correct me if I'm wrong, but
this week.
So let's wrap this up. How would you rate the meeting?
I would rate this an 8.42.
I guess you don't have to give a reason if it's an over an 8. I would have said that our discussion, I really like the capital call discussion. I'd put us at a 9, but we were, as you said, we didn't have a lot to talk about in the beginning. So that brings me down. I think I'm going to give it an 8.0.
An 8.0. That's a surprising one this week. Okay.
Yeah. So how do you want to wrap this up? You going to give me a quote this week?
No, you're going to give me a quote this week. You're good at this. Give me a good one.
At some point, I'm going to run out. So you're going to have to start banking some quotes just when I'm all tapped out. You can step in. But
I'll have I do have.
I do have one from Shaquille O'Neal, who's surprisingly he's a bit of a goofball, but it turns out he's a decent investor. But back when he was playing, he had a pretty funny quote where in the middle of an interview, he said, "I'm tired of hearing about money, 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 money. I just want to play the game, drink Pepsi, and wear Reebok."
Love it.
At the end of the day,
marketing.
at the end of the day, it is all about money, no matter what. It doesn't matter if you're investing or if you're playing basketball. So thanks for another week, Jay. We appreciate anyone who made it through that boring opening to the topic discussion and all the way down to the end. No books, I don't think, this week. So thanks everyone for just sticking with us.
Appreciate it. Thanks, everybody. Have a great week.
Yep. Stay awesome.